Yes, now it's looking at the S&P 500.
And it's checking for the 5 different sniper critical states that we've set the parameters for. The Godzilla, which is the horrible, 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 and volatile, or horrible, 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 and abnormally quiet. And then it buys breakouts. So yeah.
Yes, so it identifies which symbols are fireworks, and then
Yeah.
which ones are fence sitters, and so forth. And then on the right, it shows the corresponding. So as you scroll down through different symbols,
Yeah, that's number 18. Go to Chesapeake again.
Chesapeake,
18, number 18.
or 18.
Oh, that's a, let's see.
That's not. But
Oh, that's okay. I'm sorry. Yeah. Yeah.
so we
Pick
go to
pick
Godzilla,
H&R Block.
HR block,
Well, actually Dish Network, because I'm actually really interested in Dish right now.
Dish. Okay.
Yeah, because he's a Godzilla. So that is a, are those daily bars?
Yes.
Okay. So the blue, as I read, that blue line is the 5-day high
Yeah.
and low.
Mm-hmm.
Green line is the 10-day look back. Red line is 30, and the black line is 150. And you can see that he's oversold on the 10, 30, and 150, which makes it meet the criteria for trade location. All 3 trade locations in the look back period are massively oversold. Awesome. Then you look at then for a volatility check, you can see that the very shortest box there, the blue line, the 5-day volatility. Now that is unique to us. Haven't seen anybody else do that. Where what we're doing is we're comparing a 5-day Darvis box, which is the high minus the low, divided by the price. That gives you the range percentage of a 5-day chunk. So that's some number. It then goes back 30 5-day chunks, which takes you all the way back to the 150-day look back. So in 150 days, there are 30 5-day chunks. So you find the size of each one of those chunks on a percentage basis, and then you compare our current 5-day percentage to the histogram of previous 5-day percentages. So that means, and then we find the ones that are abnormally large or abnormally small compared to those other 29 5-day range percentages. And these critical states take a look at the things that are only abnormally quiet, an acorn ready to explode, or popcorn ready to explode, or already in play because it's a large range percentage. And now you can see on this zoom in on Dish Network, because of that 1-day horrible, terrible, bad, not good day, that 5-day range percentage is miserable. But this is brilliant because the next 4 days was failure to fail and failure to reverse. That's like a 4-day PTSD, and it hasn't broken out yet. So now what you can see is, well, Dish Network, if it was going to fail and be horrible, it had 4 chances this week to be absolutely terrible, but all it gave you was 4 dojis. So but it hasn't recovered yet because we're still in shock from that bad earnings announcement, which triggered that massive sell-off. So this is a case where anybody that was going to sell this thing on the basis of trade location would have sold it because it's oversold on 10-day, 30-day, and 150-day. And anybody who was going to be panicked to run to the exit got panicked on Monday when everything collapsed. So everybody who was going to sell sold. But what it has not yet done is attracted any buying interest. So that sets us up for a conditional entry as a sniper that says, I got this thing that is in PTSD in the box. It's either going to go to 0, which means that I can make money if it moves out to the south side, and the resumption of selling occurs. Now, there's not a lot of room in that thing because it's only at $3. So you might arbitrarily say, I am uninterested in trying to squeeze any more juice out of this thing on the short side. I'm only going to participate tactically if there's upside movement and somebody's going to come in and try to pick over the dead bones like a bunch of hyenas. So arbitrarily, I set this up now as a Godzilla, that if this thing starts moving up all of a sudden, it's going to attract momentum, and this could be a Godzilla trade. Now, we don't believe in it, and we know how to get our risk out of it, but this is a tactical opportunity to buy the exploding popcorn when this thing breaks up. What would be my upside gain? 10-day or 30-day high. So this thing could pop to 6 on the basis of momentum, which is 100% gain on about a 10 or 20 cent risk. So that is, in a nutshell, the essence of the Godzilla play. Now, the right way to play that is with the 30-day or with the 30-minute chart, because you will see the beginning of buying pressure, and you could get in and get your risk out on day one of this thing moving. So I'm ready to buy that at about $3.90 with about $1 risk. And if it works, it could go to 6, and there's my 2-to-1. And then if that worked, I could then scale up into a longer term swing trade. But that's the argument in a nutshell. That's the 3-minute explanation, the verbose explanation of the Godzilla pattern in Dish Network. And you say, hey, Dish Network still has a massive customer base. It's just that their numbers are really bad. And this is now the correct price for it. And somebody's going to buy their stream of earnings because all the pain and suffering is in there. And if this thing turned up, you could quickly see, if you look down at the MACD, you have winter, spring, winter, which is kind of ideal, that if it doesn't fail, that's going to become spring, and that's going to look like a Kata 2. And now there will be some guys, second and third mice, getting ready to buy this thing on a deep, deep, deep discount. Or it's going to fail, and then if you're an aggressive trader, you could say, winter, spring, winter, this is just the beginning of the next leg down. This thing could go to 2. Yeah, if you shorted it at $3.30 and it went to 2, you're looking at an 80% return on the short in a short, so you could get a 1-day pop on this thing. That's what makes this Godzilla pattern so damn attractive. It works in both directions. So that's the argument behind Dish. If you go to Fence Sitter, go to let's go to Boston Scientific. A Fence Sitter now is sitting exactly in the middle at the 50-yard line on the 10-day, 30-day, and 150-day. It is so exactly in the middle that it's boring. But it also had the first day of large directional move, which was down. So if this thing just stays within the trading ranges of the 30-day and 150-day, this thing has a 2-to-1 just to go to the extreme of the 10-day and the 30-day. It's so exactly in the middle that there's room for it to give you 3-to-1 on either direction. And it just happens to look like that the downward move is there. But the recovery on Friday was good enough that it could actually start to reverse and go higher. So as on a 30-minute bar at Monday's open, I can put a tightly bracketed hybrid frog on that, and I can catch the first day movement towards either the highs or the lows and just follow price. So this is one where I have no directional bias. And you could make an equally strong argument of why this thing is going to go to the 10-day low or to the 10-day high or the 30-day low or the 30-day high. It's equally likely. And so you're going to find an equivalent amount of money on either side of this thing, and it's just who's going to move first and who's going to be the momentum play. So a fence sitter is something that is exactly in the middle of his ranges. It's the opposite of overbought and oversold. It is exactly at the midpoint. And that's the beauty of the fence sitter approach. Now, the Humpty Dumpty and the fireworks pick applied materials. AMAT. Yeah, he's at 13. Yeah. So AMAT is a fireworks because they have won the race. That was the explosion that moved them to the top of the 150-day range, the 10-day range, and the 30-day range. That dude is at the top, and you say to your, and it had an extraordinarily large range, and you say, "Cripe, was that it? Was that the exhaustion bang?" If so, there will be a lot of profit preservation built in. So if it starts to fail on Monday, you're going to start seeing guys trim their positions to preserve that amazing 30-day move, which went from 128 to 140, which is a $20 move on 120, which is a 15% gain. That guy's holding on to an annual return of 15%, which he achieved in 5 days or 10 days. So he wants to protect that by selling pieces. So if it starts to fail on Monday, you will start seeing the algorithms pick that up and start punishing it to the short side, which triggers more selling. So it could easily go back to the 5-day low at 138 and still be, without any panic selling. So a fireworks puts us in the position where we say, hey, we saw the great big explosion and now it has calmed down. Is it going to fail 50% back to the previous channel? Or is there another one of those hidden bangs that surprises you? And now there's a second leg up because it actually broke above the previous 30-day high. If you go back 20 days, you'll see the previous 30-day high around the 11th or 12th of that was the previous. So, and to go one more bar. Yeah, to the right. That one was the last time this thing was in a fireworks condition. It had just blasted off with a massive move to a new 30-day high, and the next day, instead of there being follow through, it was a slight gap down and then momentum selling. And then at the end of the day, it triggered end of day momentum selling. And then the weekly bar came in with momentum selling. And pretty soon this thing went from 148 and then momentum all the way back down to 128. And then there was exhaustion and then sideways consolidation. And then apparently all the selling was done and lather, rinse, repeat. Now we're back into the oversold, quality move, but oversold. And now the buyers start incrementing in, PSAR flips, and it starts buying. It gets above the dragon, gets above the RL10, and now all of a sudden, fear of missing out comes in, and it's a blasting off to a new 30-day high. This is what manic depressive behavior looks like. So if you put a hybrid frog box around the opening on Monday, that thing's going to blow in either up or down. And if you follow that price on day one, you're going to get your risk out and you're going to be positioned for a nice swing trade in the direction of the breakout, which could be a breakdown back to the previous lows, or a breakout to go on making new 30-day highs. History would say, well, this was an amazing 10-day run in the market, and tech led the way, and AMAT was one of the best movers in that whole space. So if there was anything that was going to work to the upside next week, it would be tech and AMAT. So that's the argument to the upside. But if the entire market rolls over and tech profit taking occurs, then AMAT is a candidate to get preserved, because everybody that's holding the big open gain can look back 20 days and say, man, if I just buy and hold this, I could lose all that money in 5 days, just like the last time, just like the last 2 times when there was huge 5-day selling twice. So AMAT is very, very vulnerable, along with the entire semiconductor sector and the tech sector and the market itself, which had an extraordinary, abnormal 10-day run while the world is at war in 2 different positions. And the politics is in the silly season. So this is the fact that it has such enormous gains puts it at risk for abnormal selling. And that's what the fireworks pattern does. Whereas Godzilla takes a look at things that were just horrible at the bottom of the stack, fireworks finds things that are too good to believe in at the top of the stack. So in many ways, Godzilla and fireworks treat 2 different ends of the curve in terms of opportunity. Fireworks is glorious joy, and I wonder if there's any cake left. Godzilla says, oh, this is so bad that it's good. The fence sitter finds it right in the middle of both of those. It's the opposite of emotional distress. It is so boring and in the middle that it could start from the middle and surprise you. Humpty Dumpty is a shorter term version of a fireworks. If you pick, I don't know if there's a Humpty Dumpty would occur if you were a fireworks and then had one bad day. If you go back to the 12th on AMAT, that first big red candle after the last 30-day high, go on to the chart. Yeah, go north, go north, go up to the price bar,
Yep.
the previous 30-day high.
Oh, previous 30 days.
Yeah. So if you now go to the right, go to the right, stop. That one was a fireworks because it was at the top of an explosive move upward and you wondered what could happen. If you go one more bar to the right, that is the Humpty Dumpty. This thing was extraordinarily good fireworks, but then Humpty Dumpty fell off the wall and broke. And now you wonder, are they going to put Humpty Dumpty back together again and put him back on the wall? That's a move to the upside. Or is he going to break down and continue to fail in that way? So the Humpty Dumpty is like fireworks plus one selling day. And you're getting the second day of momentum to the downside. And you can see that that led to a low risk short side entry with Humpty Dumpty. So typical behavior is you get a fireworks pattern and it worked to the downside. And then Humpty Dumpty comes in with second day momentum to the downside. But if it reverses and says, no, that one day of selling was a fake, it could have very easily just gone right back up to the previous 30-day high. So that the day after the sell-off in Humpty Dumpty is a great non-directional bias for a large one-day move. Because now what I have is 2 days of huge daily directional volatility. And you just don't know which way it's going to break, but it's in play. So I say all that simply to say, what this template does is give you 5 mutually exclusive and considerably distinct patterns for critical state trading. If you go to the catfish looks very much like Godzilla, but it has abnormally quiet volatility. He's living on the bottom. He's very, very, very quiet, and he's waiting for opportunity to fall on him. And it's either going to break down or quietly move up. So it doesn't have the enraged volatility of Godzilla. It has the absence of volatility. It's a bottom dweller that is quietly, patiently waiting. So that's the difference between catfish and Godzilla. So this set of 5 critical states gives you 2 things at the very, very top of the stack, fireworks and Humpty Dumpty, and 2 things at the very, very bottom of the stack, Godzilla, volatile, and catfish, quiet so that you can play the extremes. And then the extra thing that it gives you is the fence sitter, which is so exactly in the middle of those trading ranges that everybody neglects those. And when something that is exactly at the 50-yard line starts quiet and slowly builds momentum, you end up incrementing into what turned out to be a move from the 50-yard line all the way to the goal line in either direction. So that is the extra one. It's the opposite of breakouts. It is the absence of breakouts plus quiet volatility, which is the genius of the fence sitter. So I say all that to say that is the explanation, one of three, of the critical state trading with the sniper. My secret sauce is how to trade the patterns correctly. Edgerater gives you the setup. About 20% of my value is the setup. 80% of my value is how to follow through with execution, assessment, and psychological prep.